Welcome back, everybody. Today I'm going to do a little impromptu video because all these big tech earnings reports came out. The market is completely selling off and there's just a lot to talk about, and I didn't want to wait till next week. So just kind of bear with me. I'm just going to kind of share my screen, the stuff that I'm looking at, and we'll just kind of go off the cuff. It won't be as scripted as kind of my normal videos, and we'll see what's going on with all these big tech companies. So first off, let's start with Amazon. And Amazon, as of right now, is down 11% in the market after their earnings call yesterday. And let's take a look at what they did. Now, when I do this, normally the first thing I like to look at is what did they actually tell us to expect last quarter, so that we kind of judge them based on their own guidance and not necessarily analyst estimates. And I've talked about this before. I don't really put a lot of weight into analyst estimates. I want to know what the company told us to expect and then see how they performed against that. And so if we look at their previous quarterly guidance that they gave us, they expected net sales to be between 144 and 149 billion, and basically a operating income between 10 billion and 14 billion. And if we look at what they actually reported, they reported net sales of 148 billion. So they were at, let me make sure. Okay, so they were at the top of that range that they provided us last quarter. And then operating income as well, 14.7 billion, which again was a little bit above the range that they gave us. So at first glance, it's like, all right, those aren't bad numbers at all. They were actually pretty good. Net sales was at the top of the range they gave us. Operating income was a little bit above the range they gave us. So why would it be down 11%? And like I talked about yesterday, not all these moves necessarily mean anything, but I do think there's an overarching story with Amazon and these other tech companies that is causing them to go down like this, even though I do think in Amazon's case, it's a little bit overdone. So if we just take a look at how Amazon did in charts, we can see that the North America revenue was up 9.1%, but it's slowing down, right, from previous quarters. International, same story. Now, AWS, which is normally the big thing that everybody worries about, was actually their best number in their whole earnings report because it's up 18.7% and it's accelerating over the past like 5 quarters, right? 1, 2, 3, 4, 4 quarters. So that is a very good story for Amazon. And, you know, if you argue that AWS is their most important business segment, which isn't, you know, a controversial thing to say, that is definitely what you want to see. And if we go down to some of their other ones, you have online stores, physical stores, where again, you see a deceleration of revenue growth. You have third party, which is still good at 12%, but again, a deceleration of revenue growth. Right. And even advertising, like advertising is one of those ones that we talked about a lot. It's high margin. It's growing at a good clip. And it has been. And at 19.5, you're like, wow, that's really good. You know, what's the problem? The problem is it's been 20, 22, 26, 26, 24. So again, decelerating growth, even though it's still good growth. And then the same story with subscription services. So what's happening now is you have these companies where a lot of them are trading at premium valuations, right? And the market's in this weird state where everyone's like, oh, everything's overpriced and the economy's unknown. And there's all these kind of worries out there while these companies are trading for a premium. So when you see this and you say, okay, here's these companies like Amazon, Microsoft is a good example, where they've been doing so well, and now that growth is decelerating a little bit, or maybe slightly missing expectations when before they were blowing the expectations away, or maybe even meeting expectations, but just not blowing them away. So when you have a market where the sentiment is just a little bit unsure, then when the biggest, strongest names in the market now start to have decelerating growth, then that should be a catalyst for people to sell off. Now, I'm not saying that I agree with it or that I'm doing that. I'm actually going to be doing the opposite, but we'll get to that at the end. But that's likely why we're seeing what we're seeing, right? Because I've heard a couple comments already. People like, hey, I thought Amazon's earnings were great. What's the problem? I think the problem is Amazon's earnings were definitely good. They just weren't as great as they've been over the past how many quarters. And when people are looking for a reason to sell off, that's as good of a reason as any. But part of what I like to do is just take a step back and look at kind of what's going on overall, right? Like I think we tend to get caught into these kind of like micro moments on a day-to-day basis with the market. It's good sometimes to just take a step back and look at the bigger picture, right? So even on Amazon's own slides, you have operating income here, and you see that it was even a quarter by quarter increase for the past year. And so now in Q2, quarter by quarter is down, which again, it's not really a huge deal because usually you will grade these things on a year over year basis. But again, that shows the strength of kind of how they were operating over the past year, where you even had a quarter by quarter jump pretty much, every quarter. But if you look at it from a year over year basis, I mean, you're talking about 91% year over year. Now, just think about that number for a minute. If you have a business that increased operating income 91%, you would say that would be a smashing good quarter, right? I mean, that's a pretty ridiculous number, especially for a company of Amazon's size. Is that something to worry about? I don't know. I don't think so. And then when you look at it on a trailing 12-month basis, again, it tells that story, right? Like each quarter, they're getting better and they're improving. And they've really done an amazing job over the past year of just increasing their profitability, increasing their operating income. And this is the story that we've been talking about pretty much all year since I added them in January. All right, and lastly, I just want to take a look at this free cash flow chart because I think this really tells the story in a good way. When you look at the previous 4 quarters, I mean, it was just aggressive growth, right? And you see Q2, it's still higher, right, than Q1 was. So there's still growth there, but it's much slower than it was the previous 4 quarters. So on a micro level, you may say, hey, growth is slowing and it's decelerating, and that's a problem for this company that's trading for a premium. And that could be justified depending on what your timeline is, what your goals are, all that type of stuff. But if you just look at it from a year over year basis, free cash flow is up 572%. Like from $7.8 billion to $52.9 billion. I mean, there is no other way to describe that other than excellent. Like that is excellent free cash flow growth on a year over year basis. Now, again, the market is forward looking. So the question isn't, wow, look at how good they did over the past year, because the stock price has gone up a ton over the past year. It's more of what do you expect in the future, right? And that's where these things come into play of decelerating growth, decelerating free cash flow growth, high premium that the stock trades for. And that's why I think we see these things when, the stock is gangbusters for the previous 4 quarters. And now in this quarter, it's good, but not amazing, blow your face off results, then people sell out. But overall, I think Amazon had a really good quarter. And the fact that AWS still has accelerating growth, I think is really good for this quarter. The other stuff in terms of retail and if the consumer is, struggling and all that may be true. It may not be true. It seems like it is based on other companies and how they've reported. But just as an example, right? So McDonald's, they, I think, have legitimate headwinds where they're going to have to do something to get that growth back. With Amazon, my opinion is slightly different. Like if the customer is slowing down, then it's just a factor of a macro issue that Amazon can't control, right? When that comes back, it's not like people are going to shop online less. It's not like they're going to shop at Amazon less. I don't see that happening. I mean, the amount of convenience and how they've integrated that into our day-to-day life, I think is something that we're not going back from. Right. I actually tweeted about it the other day because I needed something and I realized it in the morning and I ordered it like before 8 a.m. and it got to my house by like 11 a.m. And it's just amazing. Like that's become a normalized thing because of Amazon. All right, so next up, let's talk about Apple. Now, Apple's one that talk about trading for a premium. In every video that I make about Apple, there's always people in the comments that are like, it's overvalued, it's a $150 stock, there's no growth. And so let's look at what they actually told us they were going to do in the previous quarter. Now, Apple doesn't really provide detailed guidance. They just kind of give some, general expectations. So in the previous quarter, Apple said, we expect our June quarter total company revenue to grow in the low single digits year over year, in spite of FX headwinds. They expect the services business, which we're going to talk about here in a minute, to grow double digits, pretty much like it has in the first half of the year, and iPad to also grow double digits. So let's look at what they actually reported. Now, Apple reported company revenue of $85.8 billion, up 5%, and earnings per share up 11%. So right off the bat, the revenue number is up 5%, which is one of the best revenue growth numbers they've had in a while, actually, which is a little scary. But we're going to get to that in a minute because we've talked about this before. And then earnings per share up 11% is really good. Now, they grew revenue 5%, earnings per share up 11%. It's Apple, so the reason for that has to be buybacks. And if we just take a look at the details kind of in charts here, iPhone revenue was actually down 0.9%, but here we are with services, right? Up another 14.1%. And I've been talking about this for the last year or so, is that the transition of their revenue to have more of it be from high margin services is a very good thing for Apple, right? It reduces the volatility in their revenue and improves the chances that anytime people are up for a refresh of the phone, that they're just going to stay with an iPhone. And I mean, not that that's a huge issue anyway, but this obviously makes that even stronger. And obviously it helps, right? Because as those iPhone refresh cycles get longer and longer, as devices get better, or people just don't really want to trade up anymore or as much as they did in the past, then having that kind of monthly predictable services revenue is going to help them long term. And, the good part is that story has continued, which is awesome. So if we go back to the other stuff like, Mac wearables, iPad's up 23% year over year, which is interesting. But all this stuff it's important, but again, it's really iPhone, in my opinion, it's really iPhone and services. That's kind of driving it. Now, let's talk about Apple and revenue growth, because people say Apple has no growth. It's still only 5%. I think last quarter it was like 3%. And, for the premium that they trade for, that's not warranted. And I think there's probably some truth to that in terms of the premium that they're trading for today. But what we've talked about on this channel is that the revenue trend has still kind of followed the same pattern that it has in the past in terms of iPhone refresh cycles, right? Where you have these kind of big spikes in certain years, and then it goes down for a while, and then it comes back up. And then again, right? So 2017, and then it's down for a little bit, and then it pops again in 2020. And in 2021, there was COVID, there was stimulus, so there's slightly kind of a different thing there. But then for the past couple years, it's been in a downtrend. And this is what everyone says when they say Apple doesn't have any growth anymore. But you could have said the same thing back in 2016, right? In 2017. And then it popped in 2018, right? And then again, it's down in 2019, 2020, and then it popped up in 2020 because of COVID and all that. So the point that I'm trying to make is that these are refresh cycles for iPhone. They're a hardware, company, or they're at least mostly a hardware company. And those things are going to have these kind of trends and patterns to where you go through lulls because people don't need a new device, and then they get a new device. And what I've been saying for the greater part of a year is that as we get into end of 2024, 2025, that is when the time that I would expect this revenue to go back up, when the refresh cycle of all the new devices of the people that bought in 2020 and 2021 needing a new phone, that's when that should hit. Now, is it going to happen? We don't know. A lot of people say, well, Apple doesn't innovate anymore. There's no reason to upgrade anymore. And those things might be true, but time will tell, and we'll see over the next, 12 months or so if that happens. But that's why I haven't overreacted to every quarter's revenue, growth percentage, because until this pattern kind of breaks, it's not something that I'm going to worry about too much. And it's not something that I don't think is all that interesting to analyze because, again, as far as what history has told us, it's still kind of following that same pattern, which makes logical sense. The question is the growth going to be good enough whenever the refresh cycle does happen and people start buying new iPhones again? Now, I don't know if explosive revenue growth is going to come back to Apple or not. I think we'll find out a little bit over the next 12 months or so. And if we just take a look at what they expect for next quarter, they expect total company revenue to grow at a rate that's pretty similar to this quarter, so about 5% probably. And they also expect another double-digit growth in services. So, it's very high-level guidance. There's not really much to take from there other than they expect the story of this quarter to continue in the next quarter. And I don't think it's a bad story. I mean, again, until we know for sure what that refresh revenue growth rate's going to be, it's hard to judge whether or not this is good or bad. Now, from a valuation perspective, I get it, right? Even in my own kind of model where I use price to cash flow to growth, I mean, Apple is probably the worst company in my portfolio in terms of valuation, right? Which makes sense because the price to cash flow is elevated compared to others or even its own history, and the growth rate is low compared to others or even its own history, right? So it makes sense that this is, a poor valuation, which is why I'm not adding to my Apple position right now. But in general, Apple, I think, had a good quarter based on what we should expect at this part of the life cycle. And we'll just see what happens over the next 12 months. Okay, so let's move on to Meta. And this is what Meta provided as guidance last quarter for this current quarter. They expect total revenue to be in the range of 36.5 to 39 billion, and total expenses to be in the range of 96 to 99 billion, and capex 35, blah blah blah. Okay, so let's see what they actually reported. So they reported revenue just over 39 billion, so just above their guidance range, and then costs and expenses at 24, which if you extrapolate that to a year, they're right in that range of, close to $100 billion in terms of expenses. Now, one thing that really jumped out on Meta's report is their operating margin is up to 38% from 29% a year ago. And we've talked about how they've been working on trying to do better in terms of cost, but there's also something else contributing to this, which we're going to talk about in a minute that I was looking at. But just some other things that I thought were interesting here before we get to the charts. 3.27 billion on average daily active users is just an insane number. I mean, it's just insane. And then the head count, which is something, again, when we talk about cost management, it's down 1% again year over year. So they're continuing to kind of work that. Now let's look at the charts. So if we look at the charts, there were two charts that I thought were really interesting. Where are they? So one, average revenue per person, right? Q2 was 11.89, and a year ago it was 10.42. So they had a 14% increase in average revenue per person. Now, remember, they're, 3.27 billion, whatever, and they're constantly increasing this average revenue per person number, which is great. And then if we look at the average price per ad year over year percentage change, what you can tell here is a clear trend, right, in all areas of the world where the average price that they're charging for ads is increasing, right? This is very good for Meta's business. And so that's why you see their operating margin go up 9 percentage points year over year, right? It's obviously partly cost management, but also they're able to get more revenue out of their ad platform, and it's increasing kind of on a consistent basis. Like, that is a very good story for Meta. Now, in terms of earnings reports, I actually think Meta had the best earnings report this quarter out of all the big tech companies. And I just really like what they're doing. It's a company that over the past couple of months, I've talked about wanting more allocation to in my portfolio. And I finally did that this week, which I'll touch on here in a second. But if we just look at what's happening in the market today, we can see that it's pretty much a bloodbath. I mean, Apple's up. Amazon's down. Oh, it's only down 9.5% now. It was down 11% when I started this video. So that's nice. Amex is actually down big. So you have a lot of stocks here that are down big. And the market in general has been pretty volatile, right? And it normally gets that way around earnings season, but I think it's been even more so because of the state of kind of the economy, because you have these big companies that have been driving the market returns that are at pretty high valuations. That just increases the volatility around the whole market. And the volatility can definitely be scary, but it also creates opportunities for us, right? And over the past couple months in my portfolio recaps, I haven't had a lot of activity other than, incremental buys into existing positions. But after I made all those major changes earlier in the year, I just kind of was waiting around, just adding to things that I thought looked good at the time and not really doing much. But that changed this week. I was looking to get out of my Valero position, and I did. I actually trimmed my McDonald's position, believe it or not. Hurts my heart to say that. But, I said I'd never sell McDonald's, and that's true. My original 100 shares are going to probably just stay there forever. But I had an extra 25 shares that I'd gotten, in October of last year when they were down a lot. And so I sold those shares, this morning. And I'm using that money to really add to positions that I think are ones that I want to have a higher weight to. So I added to Meta. I added to Amazon this morning. I actually added to Lulu, which is a little dangerous, but I'm thinking they're going to actually do better than people expect. And I'll cover all that in my portfolio recap. So overall, everything right now is kind of selling off. Now, how long will it go? How long will it continue? We don't really know, right? Whether it's a market top or not, I don't know, but I do think the reason why you're seeing as much of the volatility, especially towards the downside, is because the biggest, strongest companies in the market are now showing decelerating growth. And, that is a reason to sell off, right? Because these are the guys that have been driving the returns in a lot of ways. And if they're showing a little bit of sign of weakness, then of course people are going to overreact. Only time's going to tell on these things, right? And I'm curious to hear y'all's opinions and thoughts about what's happening in the market right now. Are you looking at it as an opportunity? Or are you attacking kind of more defensive stocks and things that have been out of favor? Do you think that's going to be the trend going forward for a while? Let me know down in the comments below. Now, if you guys missed my previous video where I talked about kind of the craziness in the market and why it doesn't make sense a little bit deeper, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins, and I'll see you on the next one. Peace.